Your bank has a number they never want you to hit, and they'll do everything in their power to keep you from getting there. Because the moment you cross that line, you stop being profitable, you stop being vulnerable, you stop being the perfect customer they've designed their entire business model around. Today, I'm showing you why $30,000 in your savings account is the exact threshold that makes you completely unprofitable for them, and why crossing that line changes absolutely everything about your financial life and your relationship with money. Hi, I'm Matt. On this channel, I break down the money moves that actually matter, and I help you build real wealth without the BS. If you're tired of feeling trapped by your bank, if you're done being nickel and dimed by fees, and if you want to understand exactly how to break free from financial stress, hit that subscribe button, because we're about to expose exactly how they're keeping you broke and what you can do about it, starting today. Let me paint you a picture of life below $30,000 in savings right now. You're constantly running calculations in your head every single day. Can I afford gas and groceries this week? If I pay this bill today, will my other payment bounce? How many days until payday? Every single unexpected expense becomes a full-blown crisis. Car needs a repair? Crisis. Medical bill shows up? Crisis. Your refrigerator dies? Absolute emergency. You're one bad month away from drowning in credit card debt at 23% interest, one job loss away from complete financial disaster, one unlucky break away from a financial spiral that takes literal years to recover from. This isn't living, this is pure survival mode. And according to PNC Bank's 2025 report, 67% of American workers are doing exactly this right now. 67% are living paycheck to paycheck in one of the wealthiest countries on earth. Bank of America's data shows 24% of households are spending over 95% of their income just on necessities. That means nearly a quarter of all families have almost nothing left for savings, nothing left for emergencies, nothing left for breathing room. They're trapped in a cycle where one unexpected expense can destroy everything. But here's what nobody tells you. There's a specific threshold where this all changes, a number where the constant stress finally drops, where emergencies become inconveniences instead of disasters, where you actually have room to breathe and think clearly about money instead of panicking every time your phone rings. That number isn't $50,000. It's not even $20,000 anymore. With inflation crushing budgets and costs exploding across every single category, that number in 2025 is $30,000. Just $30,000 sitting in a savings account transforms almost everything about your financial reality, and your bank absolutely hates when you cross that line because you stop being the customer they need you to be. When you're operating below $30,000 in savings, you're living in what I call the survival trap. Every decision is driven by fear. Every financial choice is made from a position of weakness. The Federal Reserve's 2024 data shows that 55% of Americans have enough saved to cover 3 months of expenses. That means 45% of people would be completely underwater if they lost their income source tomorrow. And here's the brutal part. 19% of Americans, nearly 1 in 5 people, have absolutely zero emergency savings. Nothing. Complete financial exposure. Think about what that actually means. You wake up one morning and your car won't start. The mechanic says it's going to be $2,000. If you don't have savings, you have exactly 3 options. Put it on a credit card at 23% interest, take out some kind of predatory loan, or don't fix the car and risk losing your job because you can't get to work. None of these options are good. All of them make your situation worse. But when you're broke, you don't get to choose good options. You only get to choose between terrible and catastrophic. Your entire life operates on this razor's edge. That low-level anxiety that's always humming in the background never shuts off. You can't sleep properly because you're doing math at 2 in the morning. You can't focus at work because you're worried about bills. You can't enjoy time with your family because there's a constant knot in your stomach about money. According to Bankrate's 2025 Emergency Savings Report, 73% of Americans are saving less right now due to inflation and rising costs. That's up from 68% just a year ago. The squeeze is getting tighter, not looser. And here's where it gets really insidious. When you're operating from this survival mindset, you make worse financial decisions across the board. You buy things impulsively because you need that dopamine hit to feel better. You take bad deals because you don't have time to shop around. You say yes to financing offers with insane interest rates because you need the thing right now. Financial stress literally hijacks your decision-making ability. It's not a character flaw, it's biology. Your brain in stress mode prioritizes immediate threats over long-term planning. Stressed people are profitable people for banks. They're easier to upsell, easier to pressure, easier to extract fees from. The entire system is designed around keeping you stressed. But here's the part they'll never tell you. About $30,000, once you cross that line, you stop being stressed enough to make desperate decisions. You become calm enough to negotiate, patient enough to wait for better deals, strong enough to walk away. And that terrifies your bank because they've built their entire profit model around your desperation. Let me show you exactly why $30,000 is the actual number that matters in 2026, not the $20,000 everyone talked about 5 years ago. Inflation has hit household budgets like a freight train since 2020. Grocery costs are up nearly 25% according to Bureau of Labor Statistics data. Housing costs have exploded whether you rent or own. Medical expenses continue climbing at rates that far exceed general inflation. The average American household now needs significantly more to maintain the same standard of living they had just a few years ago. A $20,000 emergency fund that covered 4 to 6 months of expenses in 2020 barely covers 3 to 4 months today. The math has changed, the threshold has moved, and $30,000 is the new line that actually provides real security. So what makes $30,000 the magic number? 3 things: coverage, profitability, and psychology. Let me break them down. First, coverage. For most American households, $30,000 represents 6 to 8 months of actual expenses in 2025. Not 6 to 8 months of income, 6 to 8 months of what you actually spend to survive. Mortgage or rent, utilities, food, insurance, minimum debt payments, transportation. The stuff you can't avoid even if you lose your job tomorrow. That's real emergency fund territory. That's legitimate breathing room. Here's the contrast. The average American emergency fund right now is only $16,800. That means most people who have any savings at all are sitting below the threshold where things actually change. They have some cushion, sure, but not enough to fundamentally alter their financial position, not enough to shift from defense to offense. With $16,800, you're still vulnerable. One major emergency can wipe you out. With $30,000, you can handle almost any single financial shock without going into debt. Medical emergency? Covered. Job loss? You have months to find something good instead of taking the first desperate offer. Major car or home repair? Stressful, but manageable. Second, profitability. And this is where it gets really interesting. When you cross $30,000, you become completely unprofitable for your bank. Let me explain exactly how they make money on regular people, because understanding this changes everything. In 2024, according to the Financial Health Network, Americans paid $12.1 billion, that's billion with a B, in overdraft and non-sufficient fund fees. JP Morgan Chase alone collected over $1 billion in overdraft fees. Wells Fargo collected another billion. These are massive revenue streams, and they all come from people who don't have enough buffer in their accounts. Your account dips negative by $5, that's typically a $26.77 fee. Some banks still charge up to $35. You just paid $27 to be broke, and if multiple payments try to clear while you're negative, you get hit with multiple fees. But when you have $30,000 in savings, you never overdraft, ever. That buffer means you always have coverage. The bank makes exactly 0 overdraft fees from you. They hate that. 11% of Americans paid overdraft fees in 2024. With $30,000, you're not in that 11%. You're off their profit radar completely. Pause for a second. In the next 3 minutes, I'm going to reveal the exact 5 ways banks are systematically bleeding money from people who don't have $30,000. These are the specific profit centers they've built their entire business model around. And once you understand them, you'll see exactly why they desperately need you to stay below that threshold. Third, psychology, and this might actually be the most important part. Below $30,000, you operate from what psychologists call scarcity mindset. Every decision is about survival. Can I afford this? What if something goes wrong? I'd better not take any risks. Scarcity brain is exhausting. It's constantly running calculations. It's always worried. It doesn't let you think long term because you're too busy putting out immediate fires. Above $30,000, something fundamental shifts. You start operating from abundance mindset. Not billionaire abundance, just basic breathing room abundance. The kind where you can think clearly about your future instead of panicking about your present. We're halfway through this video, and this next part is crucial. 67% of people watching this right now are living paycheck to paycheck according to the latest data. What percentage are you? Because everything I'm about to show you determines whether you stay trapped in that system or break free from it. Stick with me. This is where it all comes together. Here's what happens psychologically when you have $30,000. You can take the slightly lower paying job that has better growth potential. You can walk away from a toxic workplace because you have a cushion. You can negotiate harder on everything: salary, car purchases, apartment rent, because you don't need any specific deal right this second. Every opportunity changes when you have options, and $30,000 gives you real options. The Federal Reserve data shows that 85% of people who always have money left over at the end of the month have 3 months of expenses saved, but only 13% of people who never have money left over have that same savings. Financial security creates financial security. Stress creates more stress. The question is which cycle you're going to break into. Let me show you exactly how banks make money on people below the $30,000 threshold. These are the 5 major profit centers, and every single one disappears when you cross that line. Profit source number 1, overdraft fees. The average overdraft fee is $26.77, but the real damage comes from how they stack. Banks process your largest transactions first to trigger overdrafts on smaller ones. One person can rack up $100 in fees in a single day. 19% of Americans have zero emergency savings, making them constantly vulnerable. Young adults aged 18 to 25 report overdraft rates of over 10% annually. That's not an accident, that's a business model. With $30,000 in savings, you simply transfer money when needed. No fee, no interest, no profit for the bank. Profit source number 2, desperation products. When you're broke and need money immediately, your options are terrible. Payday loans with 400% interest, title loans that take your car, credit cards with 23 to 29% APR. The average rate for accounts carrying balances hit 22.30% in Q4 2025. These are desperation rates. Banks love desperate people because they pay premium prices and don't negotiate. Americans paid $160 billion in credit card interest charges in 2024. When you have $30,000, you're never desperate. Need $2,000 for an emergency? Transfer it from savings. No loan, no interest, no profit for them. Profit source number 3, credit card interest. The average American with credit card debt carries $7,888. Total credit card debt hit $1.233 trillion. People below $30,000 carry balances because they can't pay full statements. They use credit cards as emergency funds and pay minimum payments while interest piles up. Here's what they don't want you to know. The credit card industry has a term for people who pay in full every month. They call them deadbeats. Seriously, you're a deadbeat if you use their card, collect rewards, and pay zero interest. They want you paying 22% forever. With $30,000, you pay in full every month. You become unprofitable. You become a deadbeat. And that's exactly what you want to be. Profit source number 4, account fees. Many banks charge $12 to $15 monthly maintenance fees, but waive them for minimum balances of $1,500 to $5,000. People living paycheck to paycheck can't maintain those minimums. Money comes in and flows right back out. That's $150 to $180 per year just to have an account. With $30,000, you easily clear any minimum. No monthly fees. Another revenue stream dried up. Profit source number 5, emotional decisions. When you're financially stressed, you make worse decisions. You buy impulsively, you take bad deals, you accept terrible financing. Bankrate's 2025 data shows 73% of Americans are saving less due to financial pressure. That pressure creates bad decisions. Stressed people are profitable people. They're easier to upsell, pressure, and extract fees from. With $30,000, you make decisions calmly. You can walk away. You can negotiate from strength. That cushion doesn't just protect you from emergencies, it protects you from your own stress responses. But having $30,000 doesn't just change your finances. It completely changes your power dynamic with the world. Let me give you a real example. Imagine your boss is treating you terribly, overworking you, underpaying you, showing zero respect. You know you should leave, but you're living paycheck to paycheck. They can treat you however they want. This is why 29% of lower-income households are living completely paycheck to paycheck with no buffer. With $30,000, everything changes. You can walk out today if needed. You have 6 to 8 months of runway to find something better, to interview carefully, to negotiate properly. Your boss's power over you just evaporated. Same job, same terrible boss, completely different dynamic. This isn't just about work. Car buying, dealers smell desperation. They pressure you into terrible financing. With $30,000, you walk away from bad deals. You wait, you shop around. The difference can be thousands of dollars. Apartment hunting, when you're barely scraping by, you take whatever you can get. Bad landlords, poor maintenance, unfair leases. With savings, you find the right place and negotiate terms. Salary negotiations, Credible's 2025 report found people with emergency funds are significantly more likely to negotiate for higher pay. Without savings, you take what they offer. With savings, you push back. Business opportunities, write this down. Every real opportunity requires financial risk. Starting a side business, taking a higher upside commission job, investing in education that increases earnings, relocating for better career opportunities. Everyone requires a cushion. Without savings, you're stuck in safe, low upside situations forever. With $30,000, you can take calculated risks that actually build wealth. The Federal Reserve data is clear. Higher income households have a 67% rate of 3-month emergency savings. Lower income households, only 24 to 40%. The gap isn't just about current income. It's about having the buffer to climb higher. Wealth creates more wealth because wealthy people can afford to take the risks that create wealth. Poverty creates more poverty because broke people have to play it safe just to survive. Here's the thing nobody tells you. Getting to $30,000 doesn't just change your present, it fundamentally changes your future trajectory. You go from surviving to having actual agency. You stop reacting to emergencies and start building towards something. You shift from being a product banks profit from to being a customer they have to serve. That shift is worth far more than $30,000. It's worth your entire financial future. So how do you actually get to $30,000? Let me break down the exact system that works. Step 1. Find the gap. Pull up your bank statements. Look at income and expenses for 3 months. Is there any gap? Even $100 per month. That's your starting point. If there's no gap, you have 2 options. Cut expenses or increase income. No magic tricks. You need more coming in than going out. NerdWallet's 2025 report found employed Americans save 23% on average, but the median is only 15%. If you can find even 10% to start, you're on your way. Step 2. Automate everything. The day you get paid, money should automatically move to savings before you see it. $50, $100, $200, whatever you can manage. Bankrate found 38% of people with savings automate contributions. Those people have significantly higher balances. Automation removes willpower from the equation. It makes saving the default. Step 3. Treat savings like a bill. Your contribution isn't optional. It's not leftover money. It's a bill you pay yourself first, as mandatory as rent. The personal savings rate in America is 4.4% according to 2025 data. That's down from 32% during the pandemic. Prove you can do better. Step 4. Use windfalls strategically. Tax refund, straight to the goal. Bonus, goal. Birthday money, goal. Every unexpected dollar goes toward building that emergency fund. Not toward new stuff, not toward vacations, toward financial freedom. The average tax refund is $2,800. That's nearly 10% of your goal from one check. Step 5. Cut one thing that doesn't matter. You have at least one subscription or expense you don't care about. Find it, cut it, redirect that money. Maybe it's a streaming service you barely use. Maybe it's eating out one less time per week. Find $50 to $100 monthly in expenses that don't improve your life. Real math. Save $500 monthly, that's $6,000 a year. In 5 years, you're at $30,000. Yes, 5 years sounds long, but those 5 years pass whether you save or not. You can arrive at 35 or 40 or 45 with $30,000 and complete financial security, or you arrive at the same age with nothing, still paycheck to paycheck, still stressed, still trapped. The time passes either way. The question is whether you'll use it to build freedom or waste it staying broke. Here's the thing about momentum. Most people who commit to this hit $30,000 faster than expected. You get obsessed watching that number grow. You find more ways to save. You get a raise and keep it instead of inflating lifestyle. The first $10,000 is hardest. The second goes faster. The final $10,000 can feel effortless because you've built the habits. Credible's 2025 report found 65% of Americans expect savings to grow next year. But expecting isn't executing. You have to do the work. Once you hit $30,000, everything I've talked about becomes your reality. The stress drops, options multiply, the bank stops making money on you. You go from product to customer, from exploited to served, from defense to offense, from reacting to building the life you want. 30,000 is not the finish line. It's not retirement money, but it is the first real milestone where the game fundamentally changes.